My dear students, welcome back to our channel. In this video, I will be explaining the MBA second semester subject Financial Management as prescribed by JNTUH and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 1 first important short question is: define finance function. The finance function means all the activities related to managing money in a business. It includes planning, raising, using, and controlling funds so that the organization runs smoothly and earns profits. In simple words, it answers three main questions. 1. How much money is needed? 2. Where to get the money from? Sources like loans, shares, savings. 3. How to use the money wisely for production, marketing, salaries, expansion, etc. Example: suppose a school wants to buy new buses. The finance function will decide how much money is required, whether to take a loan or use school funds, and how to spend and recover the cost through fees. Thus, the finance function ensures that money is available at the right time, in the right amount, and at the lowest possible cost. It is the backbone of financial management and helps the business grow successfully. Next important short question is: 2. What is meant by wealth maximization? Wealth maximization. Wealth maximization means increasing the value of the owner's investment in a business. In simple words, it focuses on making the shareholders richer by improving the market value of shares and ensuring the company grows in the long run. Unlike profit maximization, which looks only at short-term gains, wealth maximization considers long-term growth of the company, risk and return balance, and satisfaction of stakeholders, customers, employees, society. Example: if a company has 1 crore rupees, it can either earn quick profit by selling low-quality goods or invest in good technology, improve products, and gain customer trust. The second choice may give less profit now, but it increases the company's reputation and share price in the future. Thus, wealth maximization is equal to maximizing the long-term value of the firm, ensuring stability, growth, and prosperity for both the company and its shareholders. Next important short question is: 3. Write a short note on agency relationship in finance. Agency relationship in finance. In finance, an agency relationship happens when one person, the principal, hires another person, the agent, to manage their money or business decisions. Principal, the owner shareholders. Agent, the managers who run the company on their behalf. The problem is that sometimes managers, agents, may not always act in the best interest of the owners. This is called the agency problem. Example: shareholders want the company to increase long-term wealth, but managers may focus on personal benefits like higher salary, bonuses, or luxury perks, big cars, fancy offices, even if it hurts the company's profits. To solve this, companies use performance-based incentives, bonuses linked to profits, monitoring, audits, reports, shareholding for managers, so their wealth depends on company success. Thus, agency relationship highlights the conflict of interest between owners and managers, and finance aims to align both for the growth of the company. Next important short question is: 4. What is the concept of risk-return trade-off? Risk-return trade-off. The risk-return trade-off means that if you want to earn higher returns, you must be ready to take higher risks. On the other hand, if you want safe investments, you should expect lower returns. In finance, risk and return always move together. Low risk is equal to low return. High risk is equal to high return. Example: keeping money in a savings account is almost risk-free, but the return is very low, around 3–4%. Investing in stock markets is risky because share prices go up and down, but the return can be very high over time. Government bonds fall in between. They are safer than shares but give moderate returns. The key idea is that investors must balance their comfort with risk and their need for return. A young student may take higher risks, stocks, while a retired person may prefer safer options, fixed deposits. Next important short question is: 5. Define the time value of money with an example. Time value of money, TVM. The time value of money, TVM, means that money today is more valuable than the same money in the future. This is because money can earn interest or returns if invested. In other words, 100 rupee today is worth more than 100 rupees 1 year later, because if you invest 100 rupees now, it may grow to 105 rupees or 110 rupees depending on the interest rate. Example: suppose you have 1000 rupee today and you put it in a bank at 10% annual interest. After 1 year, it becomes 1100 rupees. After 2 years, it becomes 1210 rupees. So, 1000 rupee today is equal to 1210 rupees in 2 years. That is why, when comparing investments or loans, we must always consider present value and future value. TVM helps in making decisions like saving, investing, taking loans, or retirement planning. It teaches us that money has power to grow with time. Next, Unit 1. Long questions. First important long question is: 1. Explain the nature, scope, and evolution of the finance function in a corporate organization. Nature, scope, and evolution of the finance function. Nature of finance function. The finance function in a corporate organization means all activities related to managing money. It is about raising funds, using them properly, and ensuring financial health of the company. Finance is like the blood circulation system of business. Without proper money flow, no department can work. Finance managers must take two major decisions. 1. Investment decision: where should the company put its money? Example: starting a new factory, buying machinery. 2. Financing decision: how should funds be raised? Example: bank loans, issuing shares. 3. Dividend decision: how much profit should be given to shareholders and how much should be reinvested? Scope of finance function. The scope covers many areas. Estimating financial needs, planning how much money is required. Raising funds from equity, loans, or retained earnings. Utilizing funds, investing in projects that give maximum returns. Financial control, using tools like budgets, cost control, and audits. Risk management, balancing risk and return while investing. For example, if a company wants to launch a new product, the finance team checks whether it is affordable, profitable, and less risky. Evolution of finance function. Earlier, finance was seen mainly as arranging funds. The traditional view focused only on raising capital for business. For example, a company just tried to collect money from banks or investors without thinking much about how effectively it was used. But over time, the modern approach evolved. Now finance means not just raising money, but also using it wisely to maximize wealth. Modern finance includes capital budgeting, long-term investment decisions. Portfolio management, where to invest for best risk-return balance. Financial planning, future growth and stability. Today, finance is considered a strategic function. It is directly linked with company goals, shareholder wealth, and overall economic development. In short, finance function has grown from a narrow role of just arranging funds to a strategic role of planning, investing, controlling, and maximizing value. It ensures that every rupee works effectively for the success of the business. Next important long question is: 2. Discuss the goals of financial management. How is wealth maximization superior to profit maximization? Goals of financial management, profit versus wealth maximization. Goals of financial management. The main goal of financial management is to make sure that a company's money is used in the best possible way. It is not only about earning profits, but also about creating value for shareholders and ensuring long-term growth. The two important goals are: 1. Profit maximization. Focuses on earning the highest profit in the short run. Example, a company may produce low-quality goods at a cheap cost to earn more profit quickly. 2. Wealth maximization. Focuses on increasing the value of the company in the long run. It is measured by the market value of shares. Example, a company invests in research and development, builds a good brand, and keeps customers happy. This may reduce profits in the short term but increases wealth in the future. Wealth maximization versus profit maximization. 1. Time frame. Profit maximization looks at short-term gains. Wealth maximization looks at long-term growth. 2. Risk factor. Profit maximization ignores risk and uncertainty. Wealth maximization considers both risk and return. 3. Quality of decisions. Profit maximization may lead to unfair practices, like overpricing. Wealth maximization ensures ethical practices and customer trust. 4. Shareholder interest. Profit maximization benefits only in the current year. Wealth maximization increases shareholder value over time. Example for easy understanding. Imagine two shops in a village. Shop A sells cheap products at high prices to earn more profit. Customers feel cheated and stop buying after a year. Shop B sells quality goods at fair prices, builds trust, and earns loyalty. Over time, Shop B's reputation grows, and the owner becomes richer. Here, Shop B represents wealth maximization, which is always better than short-term profit. In short, the true goal of financial management is wealth maximization because it ensures long-term growth, ethical business, and shareholder satisfaction, whereas profit maximization is only short-lived. Next important long question is: 3. Explain the agency relationship problem in finance. How can agency costs be reduced? Agency relationship problem in finance. What is agency relationship? In finance, an agency relationship exists when one person, the principal, hires another person, the agent, to act on their behalf. Principal is equal to shareholders, owners of the company. Agent is equal to managers, who run the company. The problem arises because managers may not always act in the best interest of shareholders. Agency problem. Managers sometimes focus on their personal benefits rather than shareholder wealth. Example, a manager may spend company money on luxury offices or personal perks instead of investing in profitable projects. This creates a conflict between owners and managers. This conflict leads to agency costs. Agency costs. Agency costs are expenses or losses that occur because of this conflict. They include 1. Monitoring costs, expenses to check managers' activities, like audits. 2. Bonding costs, costs to assure owners that managers won't misuse funds. 3. Residual loss, the loss in value when managers' decisions reduce shareholder wealth. How to reduce agency costs? Companies use different methods to align managers' interests with shareholders. 1. Incentives and rewards. Give managers bonuses, profit sharing, or stock options. Example, if managers get company shares, they will work harder to increase share value. 2. Monitoring and auditing. Regular financial audits, performance reviews, and board supervision help reduce misuse of funds. 3. Corporate governance. Strong policies, independent directors, and transparent decision-making keep managers accountable. 4. Threat of takeovers. If managers don't perform, shareholders may replace them or allow another company to take over. Example for easy understanding. Imagine a farmer, shareholder, hires a caretaker, manager, for his farm. If the caretaker enjoys the fruits himself instead of selling them, the farmer suffers. But if the caretaker is promised a share in the profit from sales, he will work honestly. In short, the agency problem is the conflict between owners and managers in finance. It can be reduced by incentives, monitoring, governance, and aligning managers' goals with shareholders' wealth. Next important long question is 4. Explain the concept of time value of money. How are present value and future value calculated? Time value of money, TVM. Concept. The time value of money, TVM, means that money today is more valuable than the same amount of money in the future. This is because money today can be invested and earn interest, increasing its value over time. 100 rupee today is worth more than 100 rupee after 1 year. Why? Because today's 100 rupee can be deposited in a bank or invested in business to become, say, 110 rupee after 1 year. Thus, the earlier you receive money, the better its value. Present value, PV, and future value, FV. 1. Future value, FV. Future value tells us how much money today will grow in the future with interest. Formula. FV is equal to PV times 1 plus Rn, where PV is equal to present value, money today. R is equal to interest rate. N is equal to number of years. Example. If you invest 1000 rupees at 10% for 2 years, FV is equal to 1000 times 1 plus 0.10, 2, is equal to 1000 times 1.21, is equal to 1210 rupees. So, 1000 rupee today becomes 1210 rupee after 2 years. 2. Present value, PV. Present value tells us the current worth of money you will receive in the future. Formula. PV is equal to FV, 1 plus Rn. Example. If you are promised 1210 rupee after 2 years and interest rate is 10%, then PV is equal to 1210, 1 plus 0.102 is equal to 1210, 1.21 is equal to 1000 rupees. So, 1210 rupee after 2 years is equal to 1000 rupee today. Easy understanding example. Think of money like a sapling. If you plant it today, it grows into a tree in the future. Waiting to get the sapling later means losing the growth it could have achieved. Conclusion. TVM is the backbone of finance. It helps in decisions like investments, loans, savings, and retirement planning. Future value shows how much today's money will grow, while present value shows today's worth of future money. Next important long question is 5. What is risk-return trade-off? Explain with suitable examples. Risk-return trade-off. Concept. The risk-return trade-off is a basic principle in financial management. It means higher the risk, higher the expected return. Lower the risk, lower the return. In simple words, if you want to earn more profits, you must be ready to face more uncertainty. If you want safety, you must settle for less return. Why it matters? Every investor or business faces this choice. Should I put money in a safe option, like savings account, with low return? Or take a risky option, like shares or startups, with chances of big profit but also possible loss? This trade-off helps in deciding where and how much money to invest. Examples. 1. Bank savings account. Risk almost zero, safe. Return very low, say 3-4% interest. Here, you are sacrificing return for safety. 2. Stock market investment. Risk high, prices may fall. Return high, can earn 12-15% or more. Here, you take risk for the chance of high return. 3. Government bonds versus corporate bonds. Government bonds safe but low return. Corporate bonds riskier but higher interest. Student-friendly example. Imagine two friends. Ravi keeps 10,000 rupees in a bank. After a year, he earns only 400 rupees, safe but low. Rahul invests 10,000 rupees in a startup. After a year, he may earn 5,000 rupee profit or even lose money, risky but high potential. This shows the risk-return trade-off clearly. Conclusion. Finance is about balancing safety and profit. Investors must match their risk tolerance with their return expectations. A young investor may choose high-risk, high-return options like shares, while a retired person may choose low-risk, safe-return options like bank deposits. In short, no risk, no reward. More risk, more reward, but also more chance of loss.